Hi everybody, buddy, and welcome to number 8 video in chapter 15. Before we leave this reconciliation, I did want to point out one thing, that the stock options to purchase 1,000,000 shares at $85 per share were not included in the computation of the diluted earnings per share because the options' exercise price were greater than the average market price of the common shares. The options were still outstanding at the end of 2025 and will expire on June 30th, 2030. So if we summarize earnings per share here, we have our simple structure, simple presentation of an earnings per share. We compute that by taking net income, backing out preferred stock dividends, and dividing through by our shares outstanding. And then finally, we have the income applicable to common stock, and then we divide that by our weighted average number of shares outstanding. In calculating the more complex model, we have our standard basic earnings per share that we just went through. But in the case of a complex model, we have diluted earnings per share, and we're going to include all the potentially dilutive securities. Convertible securities always include those if they are diluted. Options and warrants always include them if they are diluted. And contingent issuance agreements always include them if they are diluted. So our formula then is going to be the income applicable to common stock adjusted for interest, net of tax, and preferred dividends, all on all only dilutive securities. And then we'll divide that by the weighted average number of shares, assuming maximum dilution from all dilutive securities. Okay, let's put it into practice. The Acctg company reported net income in 2025 of $30,000 and $27,000 in 2024. In January 1, 2024, it issued a 10-year, $200,000 face value, 6% bonds at par, payable annually on July 1. Each bond is $1,000 and is convertible into 30 shares of Acctg $2 par value common stock. The company has had 10,000 shares of common stock and no preferred stock outstanding throughout its life. None of the bonds have been converted as of the end of 2025. Acctg also adopted a stock option plan that granted options to key executives to purchase 4,000 shares of the company's common stock. The options were granted on January 2nd, 2024, and were exercisable 2 years after the date of grant if the grantee was still an employee of the company. The service period or vesting period is 2 years. The options expired 6 years from the date of grant. The option price was set at $4. So they want you to do a number of things. First, prepare the journal entry that Acctg would have made on January 1. So let's look at that first under Alpha. And here under GAAP, the proceeds from the issuance of convertible debt are recorded entirely as debt. So we'll debit cash and credit bonds payable. Now, under Bravo, prepare the journal entry to record interest expense in 2025. And here, to record that interest expense, we'll take 6% of $200,000, which is $12,000, debit interest expense, and credit interest payable for $12,000. Then under Charlie, we're going to compute the basic and fully diluted earnings per share for 25 and 24. The average stock price was $4.40 in 2024 and $5 in 2025, and they want you to ignore income taxes. So if we do that, we're going to start with net income here in 2025, outstanding shares, basic earnings per share. for the 2 years. Then for diluted earnings per share, we'll start with the net income of $30,000, back out the interest savings from both here and here. We have outstanding shares. Shares upon conversion, 6,000, that's 200 times 30. Options are 800. And we get that by taking 4,000 minus 3,200. And we get 364 here by taking 4,000 minus 3636. And that's here and here. And so now the total shares for diluted are going to be 16,008 for 2025 and 16,364 for 2024. So our diluted earnings per share is $2.50 for 2025 and $2.38. Okay, you'll probably have to review that in your textbook. Make sure you get it. Then under Delta, we're going to assume that 75% of the holders of Skatero's convertible bonds convert their bonds to stock on June 30th, 2026, when Skatero's stock is trading at $8 per share. Skatero pays $2 per bond to induce bondholders to convert. Prepare the journal entry. Okay, so under Delta, we're going to take the bond conversion price, which is 150 times $2, 300. The bonds payable is going to be 150 times 1,000. Common stock will be 4,500 times $2, or 9,000. And paid in capital in excess of par. Common stock will be 141,000, and we get that by taking 150,000, backing out 9,000 here, and that's the increase in paid in capital, and cash of 300. Okay. Now we'll look at explaining the accounting for stock appreciation rights plans. Company gives an executive the right to receive compensation equal to share appreciation. Share appreciation is the excess of the market price of the stock at the date of exercise over a pre-established price. The company may pay the share appreciation in cash, shares, or a combination of both. Accounting for stock appreciation right depends on whether the company classifies the rights as equity or as a liability. Companies satisfy these SARs, as they're called, as equity awards. Let's go back. Stock appreciation rights, SARs. And they classify these SARs as liability awards if, at the date of exercise, the holder receives a cash payment. To record a share-based liability, 1, measure the fair value of the award at the grant date and accrue compensation over the service period. Number 2, remeasure the fair value each reporting period until the award is settled. Then adjust the compensation cost each period for changes in fair value prorated for the portion of the service period completed. And then number 3, once the service period is completed, determine compensation expense each subsequent period by reporting the full change in market price as an adjustment to compensation expense. Okay, so if I look at that, here's our fair value. Here's our cumulative compensation recognizable. And they say the cumulative compensation is unexercised SARs to be allocated to periods of service. So the percentage accrued here is 50%. So 50% of 30,000 is 15,000. We're going to record that as expense. And then in 2026, 55,000. And then in 2027, a negative expense of $20,000. The percentages accrued is based on a 2-year service period or vesting period. Okay, now we'll look at computing earnings per share in a more complex situation, that is, if we haven't had one already. So now our long-term debt, we have $1 million of notes, $2.5 million in convertible bonds, $2.5 million in additional convertible bonds, total long-term debt of $6 million. Stockholders' equity, we have cumulative convertible preferred stock at $2.5 million. We have common stock at $500,000. And we have additional paid-in capital of $2 million and retained earnings of $9 million for a total stockholders' equity of $14 million. Okay. So, number 1, notes and assumptions. Options were granted in July 23 to purchase 50,000 shares of common stock at $20 per share. The average market price of common stock during 2020 was $30 a share. All options are still outstanding at the end of 2025. Both the 8% and 10% convertible bonds were issued in 2024 at face value. Each convertible bond is convertible into 40 shares of common stock. Each bond has a face value of $1,000, which I might add is typical. Number 2, the 7% cumulative convertible preferred stock was issued at the beginning of 2025 at par. Each share of preferred is convertible into 2 shares of common stock. Number 3, the average income tax rate is 20%. Number 4, 500,000 shares of common stock were outstanding during the entire year. Number 5, preferred dividends were not declared in 2025. Number 6, net income was $1.75 million in 2025. And number 7, no bonds or preferred stock were converted during 2025. So if we look at how we would do that, our net income, $1.75 billion, we're going to subtract the 7% cumulative convertible preferred stock dividends to get to the income applicable to common shareholders, stockholders, and then we divide by the weighted average number of common shares outstanding to get $3.15 earnings per common share. Now, for the fully diluted, 1, we determine each dilutive security, the per share effect, assuming exercise or conversion. 2, we'll rank the results from step 1, from the smallest to the largest, earnings effect per share. And 3, beginning with the earnings per share based on the weighted average common stock outstanding, we'll recalculate earnings per share by adding the smallest per share effects from step 2. We'll continue this process so long as each recalculated earnings per share is smaller than the previous amount. Okay, the first step is to determine a per share effect for each potentially dilutive security. And here is how we do that. We start with the number of shares, 50,000, multiply it by the $20 option price per share, that gives us $1 million. The average market price per share of common is $30. So the treasury shares that could be acquired with the proceeds is going to be 33,333 shares. The excess shares over the treasury shares that could be repurchased is going to be 50,000 less this 33,333, or 16,667, and that gives us a 0 here. That looks like a good place to stop this video, and when we return, we'll continue on with these calculations. Until then, bye for now.